There are 5 rules that govern how your credit card works every single billing cycle. Not in the terms and conditions, not in the disclosure statement, definitely not in the welcome packet you got when you opened the account. These rules determine how your score moves, how much you pay in interest, and whether the card in your wallet is building your financial position or quietly costing you $1,200 a year. Card issuers know every one of them. Card holders were never told. The credit card industry has spent documented money lobbying against mandatory financial literacy requirements and plain language disclosures for decades. The paper trail lives in the Consumer Financial Protection Bureau's Public Comment Archive and the Federal Lobbying Disclosure Database. This isn't speculation. It's public record. Every billing cycle, every balance reported, every decision made on your account runs through a system built to manage you without ever showing you the manual. Uninformed cardholders are simply more profitable than informed ones. That's not a conspiracy. That's a documented business structure. I'm going to walk through 5 rules lenders learn in their first week and cardholders never receive. Pay close attention when we reach Rule 3, because what I'm going to show you there is the one part of this system most people never find. Here's the first rule, and it runs every billing cycle, whether you know about it or not. Your balance gets reported to the credit bureaus once a month on your statement closing date, not your payment due date, your closing date. These are 2 different days, and the gap between them is where most cardholders lose points they didn't need to lose. Here's what that looks like in practice. You charge $4,000 on a card with a $5,000 limit. You pay the full balance before the due date. Your score still reflects that $4,000 balance because the bureaus received the snapshot on the closing date before your payment posted. The credit card industry tracks borrowers through an internal risk tier framework. The threshold separating preferred borrowers from standard borrowers is 7% utilization per card, not 30%, not 10%, 7. That number doesn't appear in any cardholder disclosure. It's built into the underwriting matrix issuers use to assign terms and rates. Most cardholders have never heard it. Lenders build their entire risk classification system around it. What that means for you right now, your payment date does not protect your score. Your closing date does. Rule 2 is the minimum payment formula, and it's where the business model becomes visible. The minimum payment on most credit cards is calculated as approximately 1 to 2% of your outstanding balance, plus that month's interest charges. On a $5,000 balance at 22% APR, that minimum comes out to around $150 per month. At that pace, you'll be paying for more than 15 years. Total interest paid over $6,000 on an original $5,000 balance. The credit card industry fought federal disclosure requirements on exactly this calculation for years. When the Card Act of 2009 finally forced total interest cost and payoff timeline disclosures onto every statement, the industry used a lender overlay to satisfy the legal minimum while limiting how much of that information actually reached cardholders in usable form. Your card issuer has already modeled how long you'll be paying and what that balance is worth in interest revenue. I ran my own balance through a payoff calculator for the first time and found a total that wasn't anywhere in the documents the card company had sent me. What that means for you right now, the minimum payment is their number, optimized for their revenue. The payoff calculator is yours. Rule 3 requires the most attention because most people are monitoring a score that isn't the one being used to evaluate them. When you apply for a credit card, the issuer doesn't pull your FICO 8 score. FICO 8 is the model you see on Credit Karma, most bank portals, and free monitoring tools. Card companies pull FICO Bankcard Scores, a separate family of models built specifically to predict credit card default risk. Experian reports version 2, Equifax reports versions 4 and 8, TransUnion reports versions 8 and 9. The specific version an issuer pulls depends on their bureau contract and internal underwriting policy. The version used on your application is never disclosed. These aren't rounding variations on the same number. The bank card model weights revolving credit history and recent high utilization far more aggressively than FICO 8 because those variables are stronger predictors of credit card default specifically. A cardholder who has been carrying a high balance for 2 consecutive billing cycles looks significantly riskier under a bank card model than they do under FICO 8. The bank card model was calibrated to find exactly that pattern. The scale itself is different. Standard FICO 8 runs from 300 to 850. FICO Bankcard scores run from 250 to 900. That means a score of 720 doesn't hold the same relative position across both models. The benchmarks most cardholders use to evaluate their credit standing were built around the model that lenders don't actually pull for credit card decisions. The approval thresholds you've internalized don't apply the way you think they do. The practical gap between what you're watching and what the issuer sees can run 30 to 50 points in either direction. You could be looking at a 720 on your monitoring app while the card company pulls a 670. Those aren't variations within the same approval tier. That's a different risk classification, different approval odds, and a different interest rate floor on any product you're offered. I've been monitoring my score for over a year, checking it regularly, watching it climb. I thought I understood where I stood. I didn't know there was a different model running on a different scale with a different number until I looked. What I found wasn't what I'd been tracking. What that means for you right now. If your score is near an approval threshold, the gap between your FICO 8 and your Bankcard score is where applications get declined without a clear explanation. What I'm about to show you in the next 90 seconds is the part most people never find. Don't stop here. This is the piece that changes what you do next. A 100-point difference in credit score costs over $95,000 on a 30-year mortgage. Monthly payment difference over $200. That's the dollar value of the gap between the number you're watching and the number the lender actually pulled. The CFPB has documented that most consumers cannot access the specific FICO Bankcard version used in a credit card decision without paying for a specialized report or filing a dispute. Issuers aren't required to disclose which model they used. You're being evaluated by a system with no obligation to identify itself. What that means for you right now, the score gap is real, it's measurable, and it has a specific dollar cost attached to it. Rule 4 doesn't require you to apply for anything. It operates on accounts you already have. Card issuers run periodic soft inquiry reviews on existing cardholders that don't appear on your report. No alert fires and no notification triggers. What you might see is the result. When your utilization on an existing card climbs above the issuer's internal threshold, typically between 60 and 75% of your credit limit, the issuer can reduce your limit without advance notice. That threshold isn't disclosed anywhere in your cardholder agreement in a form you can act on. It's part of the same underwriting criteria used for new applications applied silently to accounts already open. Here's how the damage compounds. You're carrying $3,000 on a $4,000 limit. That's 75% utilization, already in the range where the scoring model penalizes you. The issuer reviews your profile and reduces your limit to $3,500. Your balance hasn't changed, but now your utilization is 85%. Your score drops from a decision you had no part in and no alert fires. You may not notice until your next score update. The CFPB has documented this pattern across major card issuers. It is entirely legal. The provision authorizing it is in the cardholder agreement you signed, buried in the account management section that most people never read. The issuer isn't violating any rule. They're applying terms you agreed to when the account opened. That's what makes this rule different from the others. It's not passive opacity. It's active, ongoing management of your credit exposure, operating in your account without your input or awareness. High utilization isn't just a score problem. The issuer reviewing your account is evaluating whether your profile still fits their risk parameters. When it no longer fits, they adjust your terms to reduce their exposure. That adjustment costs you points. Rule 5 is where this stops being a diagnostic and becomes something you can use. Every time an issuer denies your application, raises your interest rate, or reduces your credit limit, federal law requires them to send you an adverse action notice. That notice contains 4 specific reason codes, ranked in order of impact, pulled directly from the FICO model they used on your file. Most people discard this notice. That's the single most consequential mistake in this entire list. The reason codes on that document are the most precise diagnostic data available about your credit standing. They tell you exactly which FICO variables are working against you in that issuer's scoring model, listed in order of priority. A code reading balance on revolving accounts too high points to a completely different problem than proportion of balances to credit limits is too high, even though both relate to utilization. The ranking tells you which one to address first, not what you assume is the problem. The issuer is required by law to send that notice. They aren't required to explain what the codes mean or how to correct them. What that means for you right now, adverse action notices from the past 2 years are actionable data. If you don't have them, federal law gives you 60 days from the action date to request them. Here are the 5 corrections you can implement before your next statement closes. Rule 1. Log into each card account and locate the statement closing date. It's listed separately from your payment due date, usually in the billing information section. If you want to lower the utilization that gets reported this cycle, pay down the balance before the closing date, not by the due date. A partial pay down before the statement closes reduces what the bureaus receive that month, even if you haven't paid the full balance. Rule 2. Go to consumerfinance.gov and run your current balance and APR through the CFPB's free payoff calculator. Enter the minimum payment amount. The output shows the total interest your card is set to produce and how long it takes at the current payment pace. Rule 3. If you're planning to apply for a credit card in the next 60 to 90 days, check your FICO Bankcard Score through myfico.com before you submit. The score on your monitoring app may differ from the model the issuer pulls. A 30-point gap can determine which approval tier you land in. Rule 4. Monitor per card utilization, not your overall average. The FICO algorithm weights individual card balances most heavily. Once any single card exceeds 60% of its limit, you're in the range where a periodic account review can trigger an automatic limit reduction, which compounds the utilization damage before you can respond. Keep each card below 30% individually. Rule 5. Locate any adverse action notices from the past 2 years. If you've been denied credit, received a rate increase, or had a limit reduction from any card issuer, that notice exists. If you no longer have it, you can request it from the issuer within 60 days of the action date under the Equal Credit Opportunity Act. The top-ranked reason code on that document shows what the scoring model weighted most heavily on your file. That's where to direct your correction effort, not the factor you assumed was the problem. I used to pay my balance in full every month and believed my utilization was clean. The statement closing date never appeared in any disclosure the card company sent me. I found out what it was after it had already been costing me points. What financial rule were you taught for years that turned out to be completely wrong? Drop it below. If this changed how you think about your credit card, subscribe, and the next video covers exactly how card issuers evaluate credit limit increase requests, specifically what happens to your account profile in the 90 days before you ask, and why that window matters more than the amount you request. All 5 of these rules are already public. FICO documents its scoring models. The CFPB publishes supervisory reports. The Federal Register has every Card Act filing and the industry's responses. The lobbying database is searchable. Adverse action requirements are in the Equal Credit Opportunity Act. The gap isn't access to information. It's that nobody connects these pieces into something actionable before the next statement closes. That's what this channel is built around, the specific mechanics of how credit and banking systems actually operate, translated into decisions you can make this week. Every billing cycle, these 5 rules are running on your file. Now you know what they are.